Fed had their first FOMC meeting of the year, have announced a 25 basis point rate hike, as well as potentially 6 more this year. They're basically telling all of us that they are ready to crash the economy. Long story short, the Fed just raised interest rates by 25 basis points. They said they are going to meet 6 more times this year and could very well expect to raise it in each of those meetings, which could mean we could be close to 2% interest, maybe 1.75 if they actually follow through. Previously, leading up to this meeting, Jerome Powell, Fed chairman, had indicated that they could see 75 basis points of increase this year. So that'd be kind of 1 in every other meeting, roughly. So 3 rate hikes instead of now potentially 7, which they're signaling here. We just had Christopher Leonard on the show, wrote a great book called Lords of Easy Money, history of the role of the Fed for hundreds of years, the introduction of the Fed in 1913 in its current iteration, what happened in the 70s with hyperinflation and then the subsequent crash in the early 80s, the lead up to the crash in 2008, and then most recently what's been happening in the past 10, 12 years with quantitative easing and all these kinds of things, and then particularly the past few years with just insane money printing like we have never seen. What we talked about with Chris is, in 2008, when interest rates got to like 4%, then a couple of years later is when you started to see everything come off the rails. Huge crash, 2008. We've seen that whole story play out. And so I said, hey, what's the threshold this time around? When you raise interest rates so much, the Fed's been pushing all this risky debt out. All right, it's been printing so much money, and it's been actively preventing investors from being able to stash their money in safe, risk-averse bonds, right? They've been buying like not just short-term treasuries, but long-term treasuries. They've been doing so many things to force investors to put money out into riskier deals. And so basically, long story short, when you start to raise interest rates, a lot of those riskier deals that looked good at 0% interest, maybe 1% interest, Fed funds rate I'm talking about, start to look very different when you get into 2, a lot different at 3, and like extremely different at 4% interest. And so I was saying to Chris, hey, Chris, what do you think? Is it like 4% things come off the rails, 3% things come off the rails? He goes, no, I think it's more like 2%, 2, maybe 2.5%, where really bad things happen. Why is it less 2.5% in his opinion than 4%, right? Which is what it was in 2008. Reason is that we have printed so much more money this time around, right? We have made the economy so much more fragile because there's so much cheap debt out there, so that it becomes much more sensitive to these interest rate hikes because you've levered everything up so aggressively. And so every one of these rate hikes has reverberations. Now, these reverberations play out not immediately, but over the course of months, quarters, some, 1 or 2 years leading up to 2008. You kind of start to see the Richter scales. And I know the Fed saw things were coming off the rails prior to 2008. They just didn't know, I think, how bad it was going to get. But I know they told people who made a lot of money with that information, hey, things aren't looking so hot. And then those people then sold their assets and were cash rich with the crash, and then bought up a lot of those same assets at, cents on the dollar. I know this happened. I know personally multiple people that had this insider information. Unfortunately, I didn't, and I didn't have the wherewithal. Even if I did have the information, I didn't have the ability to make literally billions of dollars off of that information. Still in school at that time. But yes, that definitely happened. The Fed knew. People got rich, wildly rich. The tolerance, and I would agree with Chris, is absolutely much lower, right? 4%, much lower, given how fragile, given how much debt has been pumped out and easy money into the economy. So what that basically means is if the Fed, now I don't think they will go through with 6 more rate hikes, because if they do, I think really bad things happen. And I think they know that too. I think there's some posturing going on here. And the market's reacting positively to this, by the way. Dow's up on the news, right? Normally you kind of say it should go down if interest rates go up. But I think the Dow likes the confidence that the Fed is showing in the economy. We'll see if that holds going into tomorrow or for the rest of the week here. But initial indications are actually good. Fed kind of signaling strength, right? Good job, Fed. But ultimately, if they follow through on this, really bad things are going to happen. Mark my word, you can't raise it that fast. You need to give investors time to absorb these rate increases and then, slowly de-risk their portfolio. They're in these deals. You're making long multi-year deals with these debt contracts, or you're buying companies fueled by basically super cheap debt. And so, you need time to adjust. And so if you legitimately are raising things by even a full percent or even 1.5%, it's not going to be good. Now, doesn't mean that they raise all this money, 1.5% in the year of 2022, and then you have a crash in 23. Maybe, I don't know. But usually I'd say there's a lag. Give yourself at least a year lag. So we're talking maybe 2024. I think this is way too aggressive. I don't think they'll go through with it. And I think they know it's too aggressive. But I do think it's actually strong positioning, even though I think it's a lot of posturing. But it is strong positioning to kind of say, hey, yeah, the economy is strong, even though it's propped up by just insane fumes. They waited too long, which was clear, right? Last year, they were telling us that inflation was transitory. We knew it wasn't. We talked about that for literally all of last year. And so they didn't raise interest rates at all last year. This is their first rate hike in years, when they should have raised rates, certainly a few meetings ago, like second half of last year. They didn't. Now it kind of seems like they are trying to make up for that. And they've seen it spiral, the inflation spiral, all these things get worse and worse and worse. Where if they had taken action a little sooner, then I think just that signal to the market could have helped cool some of these hyperinflationary pressures. So I don't know, it just seems like they're a little sluggish to act. And now if they actually go through with this action, I think they'll be way too strong with their action. Like the tact is kind of missing, right? If they're posturing, and they only do, let's say, a few rate hikes, then I agree with that. But if they really are not bluffing and they really plan to raise interest rates like at least 3 or 4 more times this year, I think they're crazy. If you like this topic, not only should you go watch the interview with Chris Leonard, Lords of Easy Money author, but you can also go watch a fun video where I just flipped a Cadillac and made a bunch of money, which you're not supposed to be able to do, buy a new car and make money flipping it. Another example about the crazy times that we live in.